Did you know that there are over 60,000 banks around the world? These institutions hold trillions of dollars and have the power to shape economies both locally and globally. But how exactly do banks affect the global economy? Are they engines of growth or sources of instability? And what are some of the ways that they've shaped our modern financial world? In this video, we'll answer these questions and more. Hello, and welcome to this channel. Let's get right into it. Number 1. Financing investments and businesses. One of the primary ways banks affect the global economy is through financing investments and businesses. Banks collect deposits from individuals and businesses, which they then lend out to other borrowers. This allows individuals to purchase homes, fund education, and invest in their futures. For businesses, banks provide the capital they need to start, expand, or innovate, all of which can lead to job creation and economic growth. For example, the government might deposit money into a bank, which then lends it out to a company that uses it to build a factory and hire workers. Or a bank might help an entrepreneur secure a loan to start a new business. By providing this type of financial backing, banks play a crucial role in stimulating productivity and economic growth, not just in a single country, but worldwide. No. 2. Controlling the flow of money. Banks have a significant impact on the global economy by controlling the flow of money. Through monetary policies and interest rates, they manage liquidity in the markets and impact how much money is available for lending and borrowing. Central banks, which are usually a country's primary bank, set the tone for interest rates. When they lower interest rates, borrowing becomes cheaper, which encourages individuals and businesses to take out loans and invest. This can boost economic activity and even inflate asset values. On the other hand, when central banks raise interest rates, borrowing becomes more expensive, which can slow down economic growth. Higher interest rates also tend to encourage saving rather than spending, which can help control inflation. For example, during the 2008 financial crisis, the U.S. Federal Reserve lowered interest rates to near zero to encourage borrowing and stimulate the economy. Similarly, today, many central banks are raising interest rates to try to combat high inflation. Number 3. Maintaining global financial stability. The banking industry is highly interconnected. A banking crisis in one country can quickly spread to others, causing a global financial crisis. Take, for instance, the 2008 financial meltdown that began in the United States. It started with the collapse of a housing market, which led to a series of bank failures and ultimately the need for a government bailout. This crisis quickly spread to other countries, causing a global recession. That's why maintaining a stable banking system is crucial for the entire global economy. Regulators and central banks work hard to monitor and control risks, ensuring that any issues are addressed quickly before they can spread internationally. For example, after the 2008 crisis, new regulations were put in place to make banks hold more capital and reduce risk. Number 4. Supporting international trade. Banks support international trade by providing the necessary tools and services to facilitate transactions across borders. Letters of credit, for example, are like financial guarantees that a bank provides to a seller, assuring the buyer that payment will be made on time. This helps to build trust between buyers and sellers who might not otherwise know each other. Additionally, banks offer international transfers, making it easier for businesses to pay suppliers and partners overseas. They also provide foreign exchange services, allowing businesses to convert one currency into another for international transactions. For example, if a U.S. company wants to buy products from a supplier in China, they would need to pay the supplier in Chinese yuan. The bank would then facilitate the transaction, ensuring that the appropriate amount is converted and transferred to the supplier's account. Number 5. Driving financial innovation. Banks are constantly innovating to meet the changing needs of their customers. In recent years, there has been a surge in financial technology, or fintech, which has pushed banks to adopt new technologies and improve their services. Online banking, mobile payments, and digital lending are just a few examples of how banks are using technology to better serve their customers. This innovation has also helped to drive financial inclusion, which is the idea that everyone should have access to financial services, regardless of where they live or their income level. For example, mobile banking has allowed people in developing countries to access financial services without needing a bank account. By driving financial innovation, banks are helping to create a more inclusive and efficient global financial system. In conclusion, banks play a pivotal role in the global economy. They finance investments and businesses, control the flow of money, maintain stability, support international trade, and drive innovation. Without banks, our modern financial system simply wouldn't function. While they do their best to keep things running smoothly, sometimes things go wrong. Banking crises can send ripples across the entire globe. Just ask anyone who lived through the 2008 financial crisis. We've seen how quickly a small problem can become a big one. So it's in everyone's best interest to keep the banks in check. Strong regulation and oversight are essential to ensure that banks operate safely and soundly. That way, we can all sleep a little easier, knowing that our money is safe and that our banks are there to serve us for years to come. Thank you for watching this video. We hope you've learned something new about the role banks play in our world. If you want to learn more about the global economy, stay tuned for more content.